Hi, everyone, and welcome to episode 89 of the Rewarding Property Decisions podcast. Now, we're starting to see a little bit more investment activity in the property market at present. Now, it's not so much probably in Melbourne. Investors are still not really re-entering that sector at the present time, but certainly in other areas around the country, the numbers, and if you look at some of the bank statistics around investor lending, there certainly seems to be a pickup in that space. So what I thought we would do today is have a look at some of the mistakes that investors make, and particularly given that a number that are probably entering the market at the moment are probably first-time investors. There may be some that are coming back in after having sold properties during the pandemic to consolidate, but there'll certainly be first-time investors around. So we can have a look at some of the mistakes that are made and how you can best avoid those, because some of them are quite straightforward and it's not a difficult thing to be able to avoid. But if you haven't done this before, then it's things that you do need to take into account. And the first one that we do come across is people probably chasing too much from a rental return perspective. Now, obviously, people are buying investment properties because it's for a financial decision. You're wanting to make money out of this. And the expenses associated with owning property are quite significant. And that's obviously from your mortgage repayments, and with the way interest rates are at present, they are quite high. But there's also insurance, there's maintenance expenses, there's management fees. And if you're in an apartment or a unit, there's owners corporation fees as well. So having to take all of that into account, you are obviously wanting to maximize the rental return where possible. But the problem can be is that chasing too much rent can actually lead to other expenses that come into play. If you look at, say, for instance, chasing an extra $25 above perhaps what might be considered to be market rent on, for instance, a $600 a week apartment, that's probably around over a 2-week period. That's about $1,300 per annum that you could make extra. And so the bonus is certainly there for the taking. The problem is, if your property sits there vacant for 2 weeks, then that extra $25 a week that you're looking to get disappears very, very quickly. And not only that, you start to by increasing that rent and having that vacancy period, if the tenant decides to move out, so perhaps if you were negotiating with an existing tenant rather than chasing a premium on a new securing a new tenant, you've then got not just the vacancy, but you've got releasing expenses that then come into play. You've got extra advertising that you've then got to pay as well. And you may actually have to contribute further works to the property, because what an existing tenant may have been prepared to put up with, so marks on the wall and things like that, a new tenant, might need to do some painting. So all of a sudden, that extra $25 a week disappears very, very quickly. So don't always focus on that premium. If you can just increase it a little bit, that can be just as beneficial. But there's also a flip side argument to this, and that can be not increasing your rent when needed. And sometimes people make the mistake of, oh, well, I've got a really good tenant here. I'm not going to move them on. I want to make sure I look after them. And that's a really positive thing. And it's something that some landlords do need to remember, that if you've got a really good tenant in there, you are better to have them in there and looking after your property. And if it's a slight shortfall in your rental return, that can be a really good thing to do. But if your rent starts to fall way too far behind market levels, it's a lot harder to bridge that gap. And if you get a tenant that perhaps, and it's an unfortunate thing, but at some point in time may not be the right tenant for that property, because unfortunately they may not be able to afford what is considered to be market rent, then it may be in everyone's best interest that they move on. But if you're not keeping your market rents up, the gap can be far too significant. And if things get pushed to VCAT, that sort of thing, it's a lot harder to bridge those gaps. So making sure that you're keeping your rental at around market levels, keeping it up at a reasonable level is really important, but also not pushing it too hard to get well and truly beyond. Another mistake that people can make is signing a tenant on a long-term lease. Now, it sounds great, and what it can do is landlords look at it and think, well, that can give me some real income certainty. I know that I'm going to get that rent. I've got a happy tenant, because the tenant gets the certainty of having security around being able to occupy. But the issue that you've got is that if you have a change of circumstances, selling a property with a lease in place is very, very difficult. It's a lot easier for a tenant to get out of a lease than it is for a landlord to get out of a lease. So if you do have a change of circumstances and decide, well, now we need to sell this property, but I've still got 18 months of a 2-year lease that I've just signed with a tenant, I've still got 18 months to go, and I need to sell this property, then you're going to be heavily reliant on other investors in the market or purchasing your property, because most owner occupiers are not going to be prepared to wait 18 months before they can move into a property. And so you push all of those potential buyers away from your property, and any investors that are there then look at it and say, well, I don't have any competition here. I don't need to pay the premium that perhaps this property deserves to have paid. And so therefore I can pick it up at a much cheaper rate. So it's something to be really, really mindful of. You don't want to be, if you are locked in on something like that, you don't want to be reliant on one buyer profile. You need to maximize things, and it can be really, really difficult to be able to. You may have to offer incentives, and the tenant is well within their rights to stay put and see out the lease, which is that has been signed. Another mistake that that plenty of investors make is not carrying out regular maintenance on a property, and it can be one of the biggest ones that investors do make. You need to remember that property is not a set and forget asset. It's not like shares. It needs maintenance. You need to take care of your property, not just from a tenant's perspective, but also from a maintenance point of view. Quite often people will think, well, I'll wait until the tenant moves out and then I'll start to do some work to the property more significant. But if there's things that need to be done while the tenant's in there and they need them done, well, then it's a good thing to just keep on top of just the little things, because continuously putting things off can lead costs to start to balloon out, and maintenance gets worse and worse. And all of a sudden, something that perhaps could be repaired now needs to be replaced. And so the expense becomes significant. So for a very small example might be a dishwasher, that you could get a part replaced, but if you don't get it done and you just keep letting it go, all of a sudden then the dishwasher has to be replaced and it becomes $1,000 instead of $200. So those are the sorts of things that you can keep on top of from a maintenance perspective. The next one is something that's probably more targeted towards investors in apartments or units, and it's not attending your owner's corporation meetings. And this is a real, I guess, a bugbear from our perspective, because it's something that's quite easily done. It's a one-off thing per annum, and more often than not, in this day and age, with the changes that have been made, a lot of owners' corporation meetings are done online. So they're done via a Zoom or a Teams meeting. So it's a very easy thing to do, to sit at home and do it whatever evening's been organised. And what it does is it means that you can have a lot more say and a lot more control over your asset as a whole. Now, if you've got a house, you've got complete control. But as an owner within an apartment development, you have a lot more control and a lot more say in what's going to be done if you attend your owner's corporation meetings. It gives you the opportunity to create a relationship with your owner's corporation manager, but also to create relationships with other like-minded owners within the development. And it really gives you a lot of say in how things are going to go. And by regularly attending your OC meetings, if, for instance, a quorum is not achieved at an AGM, then all the decisions that are made at that meeting become interim for 28 days. And now, if none of those that didn't attend the meeting object to the decisions that were made, then you can't get out of them. They become the decisions that are to be made. And so even a small group of owners within a slightly larger development can really run and control everything that goes on and make sure that the right decisions are being made in the right interests of the property. And if works are not then going to be done, then things start to slip. And we've seen this plenty of times over the years, where developments have been really well maintained and well looked after, and it might have been driven by one or two people. They sell out of the block, and then there's not the drive there for others to do it. And all of a sudden, what has been a really well-maintained owners corporation and development with gardens and communal areas, stairwells, that sort of thing, start to really drop off, and the quality isn't there. Now, on the flip side, you can get into a block, providing you do you do your due diligence first, you can get into a block that hasn't been well maintained, and you might be able to start to change that. Now, you need to be very careful in that regard, because it may not be being managed and looked after, because there's a few people that are attending and don't want to spend money. So there's risks around that side of things, but it's something that can be very well controlled and very well looked after. And the other side of it is you need to attend these meetings, because otherwise, if you've got a large number of, or a core number of owner occupiers within a development, sometimes it can go on the flip side, where instead of it being things not being done, it's too much is being done, or money is being spent on areas that are not necessarily financially necessary from the block, but from an owner occupier's perspective, it increases their enjoyment of living within that development. Now, that's not necessarily going to be financially beneficial for you as an investor. So you have a lot more control to make sure that unnecessary expenses aren't being made to a development. And then another final one that a lot of investors can get caught up on is that they get far too focused on fees being paid to a property manager. Now, as I said earlier, no one wants to be overspending. And with the cost of living the way things are at the moment, we want to be able to try and keep expenses to a reasonable level. But having said that, this is possibly going to be one of the largest investments, apart from perhaps your home, that you're going to make as an owner. And by skimping on management fees and not necessarily getting the right manager involved means that you can lose control or not have your asset looked after in the right manner. Many landlords, they do focus too much on the fees, and by going at a lesser rate, you really do get what you pay for when it comes to property management. And I think if you're really pushing back and trying to get your fees dropped to unreasonable type levels, then you may end up finding that you'll get a more junior property manager rather than getting someone that is going to know legislation really well. They're going to make sure that they manage things. You'll get stability of tenure with that property manager as well. They'll have great experience. They'll know their market intimately. And they'll probably have really good access to good tradespeople and things as well, which means that you'll get things done not only in a timely manner, but in a quality manner as well. So I'll give you a bit of an example here from a numbers perspective. If you've got a property that's worth around $1 million, the rent might be about $700 a week on something like that. Now, the difference between a top end, or the upper end property management and the lower end from a fees perspective might be around sort of 2.2%. Now, 2.2% management fee on a $700 a week over an annual basis, it's going to be just over $800 a week. $800 per annum that you'll save. Now, that's not an insufficient amount, but that's also before tax deductions are factored in. So it works out at being just over probably or around a week's rent. Now, if you've got the right property manager in there looking after your property in the right manner, that's going to be very, very beneficial, even that extra $800 a week. And the thing that investors do sometimes get caught up on is if you get a really good run and you've got a tenant that's not worried about the property and they're paying their rent on time, people look at it and say, what's the property manager actually doing? They're just collecting the rent for me. I don't need any. But as soon as something goes wrong, a really good property manager will be worth their weight in gold. And it's something that you do need to be very mindful of to make sure that you've got really good representation when it comes to looking after your property. So today's case study comes from a client that we purchased an investment property for a number of years ago. It was in a really good quality block, but hadn't been too much done in the common areas in recent times. They attended the first owners corporation meeting, so they did the right thing and came along. And there's a huge big concrete area between the two blocks with this development. It's two buildings and there's a big concrete strip up the middle. And this client of ours attended the owners corporation meeting and found that there'd been some plans in the past to put some garden beds and planter boxes within this common concrete area to try and green it up a bit, because it was very stark and bland. And nothing had been done about these. They'd had proposals put forward, but it really hadn't been driven. So he got in there and he went and got further quotes, got it all updated, took it back to the owners corporation, explained how beneficial it would be, got some input from us around adding value and how it could be beneficial longer term. He also worked in getting external painting done to the building at the same time. And as a result, there's been record prices set with the most recent sales in this development, and it's greened up the area. It's made it really really attractive. And I've heard from him that others within the block are now saying that they have regular catch-ups as a group in this area because it is just far more user-friendly. And from discussing things with some of the agents in and around that area, they've said that the feedback that they get when they have open for inspections from a rental and from a resale perspective now is really significant, because it was always something that was a bit of a shortfall, but people can see that it's got a really good community feel, and it's been evidenced by the prices that are being achieved from a rental and from a sales perspective since this work has been done. And that was all driven by one person making sure that they could show and explain to people why it was going to be in everyone's best interests to carry out this work. And that's just by attending your owners' court meetings and getting an understanding and building relationships with others that are within the development. So that's about it for today's episode. Thanks very much for joining me. Episode 89, I think it was today. As always, please feel free to share the podcast far and wide. If you've got any further information, please visit our website, wakeland.com.au. Otherwise, we wish you all the best with your property decisions.